Something important is happening in the silver market, and it is happening faster than most people can process. Prices are not just moving higher, they are accelerating. When markets accelerate like this, it creates opportunity, but it also creates risk. Ignoring either side is how people get hurt. Welcome back to Gold Rush Reporter. If you are watching silver right now, this is not a time for emotion. It is a time for clear thinking. Silver has broken into new price territory, and it is doing it aggressively. New highs are being set within hours, sometimes while people are still talking about the previous level. That speed alone should tell you something. Markets do not behave this way when conditions are calm. This is what stress looks like. At the same time, it's important to say something most people don't want to hear. Silver is extremely overbought in the short term. That does not mean the bull market is over. It means the rally has moved too far, too fast. When that happens, pullbacks are not only normal, they are necessary. Every major silver rally in history has included sharp corrections. In fact, the strongest bull markets usually have the most violent pullbacks. This is where inexperienced participants get shaken out. They buy near highs, panic during corrections, and sell at a loss, only to watch price recover later. That cycle repeats again and again. So let's be clear. A pullback does not mean silver is failing. It means the market is resetting. It allows prices to stabilize, leverage to clear, and demand to rebuild. A market that only goes straight up is unstable. Corrections are part of healthy price discovery. What matters is not whether silver pulls back. What matters is how people react when it does. Right now, many new participants are entering the market. They see fast gains and assume prices only go one direction. That mindset is dangerous. When silver drops 5 or 10% in a short period, fear replaces excitement very quickly. That fear leads to bad decisions. You do not want to buy silver at elevated prices and then sell lower simply because you were not mentally prepared for volatility. That is not investing. That is emotional trading. Silver is a small market compared to gold, stocks, or bonds. Because of that, price moves are amplified. It goes up faster, and it also pulls back harder. That volatility is not a flaw. It is a feature of the market. Another mistake people make is focusing too much on daily prices. Watching every tick creates anxiety and clouds judgment. Short-term price action does not change long-term fundamentals. If your entire conviction disappears after one red day, then your position was never well thought out to begin with. Patience is being rewarded right now, but patience will be tested again during corrections. That is how markets work. The goal is not to predict the exact path silver will take over the next few days or weeks. The goal is to understand the environment we are in. Accelerating prices, rising volatility, and growing participation all point to a market entering a new phase. When silver starts moving this fast, the most important thing to understand is why the speed itself matters. Fast price movement is not just a result of excitement. It is usually a symptom of imbalance. Either supply is tight, demand is surging, or confidence in pricing is breaking down. In silver's case, it is all three. Silver is not a large, deep market. Compared to gold, it is tiny. Compared to stocks or bonds, it is microscopic. That means it does not take much new money to move the price. When capital starts rotating into silver from other assets, the impact is immediate and exaggerated. This is why silver often behaves in ways that shock people. It can sit quietly for years, frustrating long-term holders, and then suddenly explode higher in a matter of weeks or months. When that happens, the move feels irrational to outsiders, but it is actually a release of long-building pressure. Another critical factor is positioning. For a long time, silver has been under-owned. institutional exposure has been limited, retail participation was low, and sentiment was largely dismissive. That created a compressed spring. Once prices broke through long-standing resistance levels, momentum traders and late participants rushed in at the same time. This is how markets go from orderly to chaotic. As prices accelerate, people begin extrapolating recent moves into the future. Targets become emotional rather than analytical. Some start believing prices will never come down again. Others panic and assume a crash is imminent. Both extremes are wrong. Parabolic moves do not end because price is too high. They end when buying power is exhausted or when an external shock intervenes. Until then, volatility increases and corrections become sharper but shorter. That is the phase silver is entering now. It is also important to understand the difference between healthy corrections and trend reversals. A correction is a temporary pullback within an uptrend. A reversal is a structural change in direction. Most people misinterpret corrections as reversals because they focus on price instead of context. In strong silver markets, corrections often happen suddenly. Prices can drop several dollars in a short time, shaking confidence. Then they stabilize and move higher again. This is why emotional traders get chopped up while disciplined participants stay positioned. Comparisons to other markets are often misleading. Some people point to cryptocurrencies and say silver could crash the same way after a rapid rise. That comparison ignores key differences. Silver is a physical commodity with industrial demand. It is consumed. It cannot be created out of thin air. Its supply is constrained by mining and recycling. That does not make silver immune to bubbles, but it does make its dynamics different. When price rises too fast, demand does not disappear. It shifts. Industrial buyers may delay purchases briefly, but they cannot opt out entirely. That creates a flaw that purely speculative assets do not have. Another misconception is that corrections are bad for long-term price discovery. In reality, corrections help build stronger bases. They remove weak hands and excessive leverage. They allow new buyers to enter at more reasonable levels. Without corrections, markets become unstable and prone to crashes. The danger right now is not price going up. The danger is people entering without understanding volatility. Many new participants are emotionally anchored to recent highs. When price dips, they feel regret and fear instead of opportunity. This is where mindset matters. If you believe in the long-term fundamentals of silver, short-term price swings should not dominate your thinking. If you do not, you should not be involved in the first place. Another factor to watch is crowd behavior. As more people talk about silver, confidence rises. Confidence eventually turns into complacency. That is when markets deliver sharp reminders. The goal is to stay aware without becoming fearful. Silver is doing exactly what small stressed markets do when attention and capital converge. It moves fast, it overextends, it corrects, and then it moves again. At this point, it is critical to shift focus from short-term excitement to positioning and strategy. Fast-moving markets like silver are dangerous for those who react emotionally. The difference between success and failure often comes down to preparation, mindset, and disciplined execution. First, let's talk about corrections. When silver pulls back after a rapid rise, it is not a signal to panic. Pullbacks are part of healthy price discovery. They allow prices to stabilize and new buyers to enter. Without them, markets become unstable, exaggerated, and prone to sharp crashes. Understanding this is crucial because it helps you make rational decisions rather than emotional ones. Many new participants make the mistake of focusing on the absolute price instead of context. They see silver drop from 79 to 76 and assume the rally is over. They panic sell and lock in losses. Meanwhile, disciplined participants view the same movement as an opportunity to add to positions at a discount. In volatile markets, perspective is everything. It is also important to understand market scale. Silver is tiny compared to gold, equities, or cryptocurrencies. Its liquidity is limited, which means large price moves happen easily. That also means market manipulation is easier in theory, but more importantly, supply and demand imbalances have exaggerated effects. When industrial demand is rising and retail participation surges, small changes in buying pressure create outsized price moves. The same rules apply to timing. Trying to catch the exact bottom during a correction is almost impossible. Markets move unpredictably in the short term, and emotional decisions often lead to missed opportunities or unnecessary losses. The goal is to think in ranges and probabilities, not exact numbers. Buy when conditions are favorable, but do not chase the lowest possible price. Corrections are inevitable. Trying to outguess them is a losing game. Another factor is risk management. Fast markets are exciting, but they are also unforgiving. Decide ahead of time how much exposure you want and stick to it. Do not allocate money that you cannot afford to hold through volatility. Long-term participants benefit from patience and consistency, not impulsive decisions based on fear or greed. Education is a critical advantage in these markets. Knowing the structure of silver, how industrial demand works, and what drives supply constraints helps you make decisions confidently. Many new participants enter with only basic knowledge and rely entirely on social media chatter or price charts. That is a mistake. Informed participants make decisions based on real market fundamentals, not hype or speculation. Psychology also plays a role. Fast moves generate euphoria. People see their accounts increasing and assume prices will only go higher. That mindset encourages over-leveraging, overbuying, and emotional trading. Experienced participants recognize this as a warning sign. They stay calm, follow their plan, and avoid reacting impulsively. Additionally, consider how exits work. Selling is more complex than buying. It is not just about price. You need to think about how and where you will sell, reputation, if using online platforms, and timing relative to market conditions. Poor planning during a market peak can turn profits into losses. Those who plan ahead reduce risk significantly. Finally, understand that silver's rally is still in an early phase relative to long-term trends. The acceleration may slow temporarily during corrections, but the underlying drivers, industrial demand, limited supply, and growing investor interest, remain intact. Volatility should be expected and embraced, not feared. To fully grasp what silver might do next, it is essential to look at historical bull markets and the patterns they create. History does not repeat exactly, but it often provides a framework for understanding market psychology, structure, and the magnitude of moves. Silver has experienced explosive rallies in the past, and studying them can reveal what to expect in the current phase. One of the clearest examples is the late 1970s. During that period, economic uncertainty, inflation, and distrust in fiat currency drove investors to tangible assets like silver. Prices did not climb gradually, they went parabolic. Within a relatively short period, silver's price multiplied several times. Those who were unprepared for the speed of the move either panicked during corrections or missed the rally entirely. The lesson is clear. Fast-moving markets require discipline, patience, and risk management. Another example is 2011. That rally was largely driven by investment demand after the global financial crisis. Silver hit around $50 per ounce, but the conditions then were different. Industrial demand was lower, inventories were more stable, and participation from retail investors was limited. Today, industrial demand is much higher, supply is tighter, and new participants are entering rapidly. That structural difference suggests that the current move may have more momentum potential than previous rallies. It is also important to understand parabolic moves. Parabolic rises are not linear. They start slowly, accelerate dramatically, and often end in sharp but brief corrections before resuming or topping out. The danger for inexperienced participants is interpreting these corrections as the end of a trend. In reality, they are usually temporary pauses within a larger bull market. Correctly identifying a correction versus a reversal can make the difference between a profitable position and a costly mistake. Another factor to consider is market size. Silver is tiny compared to gold, stocks, or cryptocurrencies. Small markets react faster to capital inflows and are more sensitive to sudden shifts in supply and demand. That means even moderate buying pressure can produce outsized price moves. Conversely, when profit-taking occurs, prices can drop quickly. Understanding this dynamic helps participants anticipate volatility and respond rationally. Psychology also plays a critical role. As prices rise rapidly, euphoria spreads among participants. New buyers may assume prices will only go higher, while early buyers may feel invincible. That combination often leads to over-leveraging, emotional decisions, and misjudged risk. Historical rallies show that those who maintain perspective, follow a plan, and remain disciplined tend to navigate volatility more successfully. Market structure is another key point. In prior rallies, corrections served a purpose. They allowed weak hands to exit, removed excessive leverage, and created stronger bases for future moves. A correction is not the enemy. It is part of the market's natural mechanism for price discovery. Long-term participants who understand this view pullbacks as opportunities rather than threats. Industrial demand and supply constraints remain a critical foundation. Unlike speculative assets, silver is consumed in electronics, medical applications, solar panels, and other industrial uses. Supply cannot expand immediately in response to rising prices because most silver is a byproduct of other mining operations. This creates a floor under the market, distinguishing silver from purely speculative assets. Finally, context matters. Comparing silver to cryptocurrencies or stocks can be misleading. Those markets have different fundamentals, liquidity, and drivers. Silver is a physical commodity with real industrial and investment demand. Its historical moves are shaped by tangible factors, not just sentiment. Understanding these fundamentals allows participants to evaluate risk realistically. Now it is time to pull everything together and focus on practical takeaways for disciplined participants in the current silver market. The environment is fast, volatile, and emotionally charged. Knowing how to navigate it separates strategic investors from reactive traders. First, accept the reality of volatility. Silver is moving quickly, and daily swings can be significant. This is normal for a small, stressed market. Do not interpret every pullback as failure or every spike as guaranteed continuation. Volatility is part of price discovery. Correcting after a strong rally is healthy, and it allows the market to stabilize before the next move. Second, position sizing and planning are critical. Decide in advance how much exposure you are comfortable holding and stick to that allocation. Avoid over-leveraging or putting capital at risk that you cannot hold through a correction. The strongest participants maintain discipline even when emotions are high, resisting the urge to chase short-term gains or panic during drops. Third, maintain a long-term perspective. Daily prices are noise. Focus on structural drivers, industrial demand, supply limitations, global participation, and long-term trends in investor behavior. These fundamentals determine the market's trajectory far more than short-term fluctuations. Being able to distinguish temporary pullbacks from structural reversals is essential. Fourth, Understand the psychology at play. Rapid gains create euphoria, attracting new participants who may not fully grasp the risks. Historically, the strongest rallies follow periods of underappreciation and limited ownership. Once a broader audience becomes involved, emotional trading intensifies. Discipline, patience, and adherence to strategy are the defenses against emotional mistakes. Fifth, learn from historical patterns. Parabolic moves, like those seen in the late 1970s or 2011, always include steep pullbacks. They do not follow straight lines. Corrections allow markets to reset, remove weak hands, and provide opportunities for more strategic entries. Investors who anticipate and plan for these phases are better equipped to benefit without being shaken out by short-term volatility. Sixth, think ahead about exits. Buying silver is only half the process. Selling requires strategy, especially in a volatile market. Decide in advance how you will liquidate, in what quantities, and through which channels. Consider timing relative to market conditions and potential premiums from physical sales versus online platforms. Planning this ahead reduces risk and preserves gains. Impulse selling or poorly timed liquidation often erodes profits. Seventh, avoid emotional comparisons to other markets. Silver is different from cryptocurrencies, stocks, or bonds. Its behavior is driven by industrial demand, supply constraints, and market psychology. Comparing its daily swings to speculative markets is misleading. Focus on the fundamentals, not hype. Eighth, use corrections as opportunities. Temporary dips do not signal the end of the rally. Instead, they provide chances to add to positions at better prices. Recognize that small retracements are normal in strong bull markets and act accordingly. Patience and strategic action during these periods are what compound success over time. Finally, maintain perspective and preparation. Fast-moving markets reward those who think systematically. Emotional decisions, fear of missing out, or impatience lead to mistakes. Discipline, research, and a clear understanding of structure, risk, and psychology are the tools that protect capital and position participants to benefit. This analysis is for educational purposes and is not financial advice. Precious metals carry volatility and risk. Perform your own research, understand your objectives, and make decisions based on your risk tolerance. No prediction is guaranteed, and all markets can experience unexpected shocks. Silver is accelerating, but fundamentals remain strong. Industrial demand continues to grow, supply is constrained, and investor interest is rising. Corrections will happen, but they are part of the process, not a reason to panic. Strategic participants who understand history, volatility, and positioning can navigate this environment effectively and take advantage of opportunities while mitigating risk. By staying disciplined, focusing on fundamentals, and planning both entries and exits, investors can approach this phase of the silver market with confidence, perspective, and control over outcomes.